Please like, share, and subscribe. Wishing you happiness and good luck every day.
Now that title on your screen is a pretty bold claim, right? You can be a stock market genius. But what if being a genius has nothing to do with your IQ score or some fancy finance degree? What if it's really just about knowing where to look, knowing the secret hiding places where the real profits are? Well, that's exactly what we're about to dive into.
We're pulling back the curtain on the core ideas from Joel Greenblatt's classic book. And look, this isn't just some theory from an academic. Greenblatt is a legendary hedge fund manager who put these exact strategies to work and achieved some pretty mind-blowing real-world results.
So this is the million-dollar question, isn't it? We're always told that we, the little guys, are up against this army of pros with supercomputers and billions of dollars to throw around. It feels like a totally unfair fight. But what if that whole idea is just completely backward?
And boom, there's the answer, straight from the man himself. His entire argument is just so provocative. The game isn't just rigged against you, it's actually tilted in your favor. The secret is understanding the very strict and kind of weird rules that all the professional investors are forced to play by.
Okay, so let's get right into it. What is this unfair advantage? Well, it turns out that the very structure of professional money management, their huge size, their need to perform every single quarter, creates massive blind spots. And those blind spots, that's where you find the gold.
This comparison really lays it all out. A professional who's managing billions of dollars is like a giant whale in the ocean. They can only hunt for other whales, right? They simply can't waste their time on a small, promising company because it just won't move the needle on their giant portfolio. So they're forced to buy hundreds of big, boring, well-known stocks. But you're like a small, nimble fishing boat. You can go anywhere. You can put all your capital into your absolute best, most exciting ideas, no matter how small the company is. And you don't have a boss breathing down your neck, obsessed with this quarter's performance. You can actually think long-term.
Just think about what this means for a second. Because of their sheer size and all their internal rules, whole sections of the stock market are basically off-limits to the big money. We're talking about areas like spin-offs, weird merger securities, corporate restructurings. These become your exclusive hunting grounds.
You know, Greenblatt has this great analogy for it. Success isn't about being a master financial modeler who can build the most complex spreadsheet. It's about being the plumber who knows exactly where to bang on the pipe to fix the problem. It's not about being the smartest person in the room. It's about knowing exactly where to look for those situations where the market is systematically getting it wrong.
So let's talk about the first and maybe the most powerful hiding place Greenblatt points us to: spin-offs. This is an area where, time and time again, studies have shown that you can find incredible deals, all because of the weird way they're created.
So what even is a spin-off? It's actually pretty simple. Imagine a giant company decides it doesn't want one of its smaller divisions anymore. Instead of selling it off, they just turn that little division into its own brand new company, and they give shares of that new company to all of their existing shareholders.
And here is exactly why that creates a huge opportunity for you. All those big institutions, the giant mutual funds that own the parent company, they suddenly get shares of this new, tiny company dropped into their lap. It's probably too small for them to own, or maybe they just don't understand it. So what do? They sell. They just dump the shares, often without even looking at the price or thinking about what the company is actually worth. And all that forced, indiscriminate selling is what creates the initial bargain.
The StratTech Securities story from the book is the perfect example. StratTech was this tiny little car lock maker that was spun out of the much bigger engine company Briggs & Stratton. And just like the theory says, the big funds that own the parent just dumped their new StratTech shares and the price got crushed. But Greenblatt's team actually did the work. They read the public filing, this document called a Form 10 that has all the details, and they found a little nugget of gold hidden inside, a massive new contract with Ford that hadn't even started to show up in the company's profits yet. It was the perfect case of finding treasure in what Wall Street had tossed in the trash.
Now, spin-offs are kind of the main event, but this same logic applies to a whole bunch of other special situations. These are just messy, complex areas where most investors get scared and run away, which, you guessed it, creates pockets of incredible value.
Now, Greenblatt makes a really important distinction here. A lot of pros play a game called risk arbitrage, where they're betting on announced mergers and takeovers. He says this is a terrible game for us regular investors. The potential upside is tiny, the risks are huge and often hidden, and you're playing against the world's experts. So that's a hard pass.
But merger securities, that's a completely different ballgame. Sometimes when companies merge, they'll issue these weird, complex little side securities, like warrants, for example.
And because they're kind of complicated and hard to value, the pros who get them often just sell them for pennies without even thinking. For an individual who's willing to do a little bit of math, these can be absolutely fantastic bargains.
And you see the same theme play out with bankruptcies and corporate restructurings. The moment most people hear the word bankruptcy, they run for the hills. But that's the whole point. In all the chaos of a company reorganizing itself, its different parts and its new stocks are often completely mispriced by the market, creating massive opportunities for anyone brave enough to look.
Okay, so this all sounds great in theory, but how do you actually go out and find these things in the real world? Well, the book lays out a surprisingly clear treasure map for us.
And you know what the best part is? This isn't some secret inside information. It's all out there in public. You can read the exact same official SEC filings the pros are reading. You can keep an eye on the financial news to spot when these spin-offs and mergers are announced. You can use simple tools to figure out if a new company is cheap or expensive. And as we're about to see, you can even just copy the masters.
I love this. Greenblatt literally gives you permission to steal ideas. He says to go find the best investors who specialize in these kinds of weird situations, look at what they're buying in their public filings, and use that as a starting point for your own research. You still have to do your own homework, of course, but it's such a powerful way to generate ideas.
Okay, let's wrap this all up. What is the big genius takeaway from this whole treasure hunt? And this brings us right back to that title. Being a stock market genius has nothing to do with being able to predict the future with a crystal ball. It's about having a process, a disciplined framework for finding value in the places nobody else is looking. It's a skill, and it's a skill that anyone can learn.
So, the final question is, does it work? I mean, really, does this whole process actually make money in the real world? Well, the proof is in the performance. Just take a look at this number. 50%. That's right, 50%. That was the average return per year of Joel Greenblatt's own fund for almost a decade straight. He wasn't just writing about a cool theory, he was out there doing it and producing some of the most unbelievable investment returns you will ever see. That's the ultimate proof that this treasure map actually leads to real treasure.
At the end of the day, the takeaway is really simple. The market is always creating these little pockets of hidden value through spin-offs, mergers, and all sorts of other messy situations. The pros are forced to ignore them, all the information is public, and the treasure map has basically been drawn for you. So the only question left is the one right there on your screen. Are you willing to look?
Welcome to The Explainer. Today, we are digging into a classic investment book to tackle a huge question. Can a regular person, someone like you, actually beat the pros on Wall Street and build a fortune? You know, the answer is not what you'd expect.
So let's just picture this for a second. Imagine it's a big showdown. In one corner, you've got the titans of Wall Street. I'm talking portfolio managers who control billions of dollars, and they're backed by entire armies of super sharp, fresh-out-of-school MBAs. And, well, in the other corner, there's you. Kind of feels like a totally unfair fight, doesn't it?
And you know what? You're right. It isn't a fair fight. But here's the crazy twist, and this is the part I absolutely love. The game is actually rigged in your favor. Yeah. You heard me. Those pros on Wall Street with all their money and all their resources, they're the ones who are actually at a disadvantage. Let's break down exactly how that works. Okay, so to really get how this is even possible, we've got to pull back the curtain on this whole myth of Wall Street genius. We're going to start by looking at what they teach in business schools. Then we'll peek into what the professionals are really doing. And finally, we'll uncover the hidden rules they're forced to play by. Rules that, believe it or not, create your single biggest opportunity.
Now, let's be clear. Your edge, your secret weapon, it's not some magic formula or a super complicated financial model. No, according to our source material, your real power comes from understanding a simple, fundamental paradox. The very things that make the experts look so powerful are the exact same things that are holding them back.
All right, so first things first, let's just go ahead and challenge some of the conventional wisdom out there. We're going to look at the two main places most people get their financial advice from, the professors in academia and Wall Street itself. And what we're going to see is that while their theories might make sense in their own little worlds, they completely fall apart for individual investors like you. Let's start with the academics. The bedrock of modern finance, the stuff they teach in every university, is this thing called the efficient market theory. The basic idea is pretty simple. There are so many brilliant people watching every single stock all day long that any new piece of information gets priced in instantly. So, in theory, this means there are no bargains, no hidden gems just sitting there waiting for you to find. And of course, this all leads to the one big, depressing conclusion that's taught in so many business schools. You can't beat the market, so don't even try. I mean, students literally pay a fortune to learn all these complex formulas that are designed to do one thing. Hopefully, keep up with the market averages. That's it. But here is the absolute key. Even if we say, okay, sure, maybe that theory is true for the giant, famous companies that academics love to study, their conclusions just don't apply to you. And why not? Because you are not forced to play in that same sandbox. You get to play a completely different game. So now let's pivot and look at the actual professionals. And honestly, the data here is kind of shocking. As a group, professional fund managers consistently, year after year, fail to beat the market. In fact, if you look at this chart, they usually lag behind about 1% per year, and that's before you even factor in their massive fees. So it begs the question, if these guys are the experts, why can't they win? The answer, and this is something that really blew my mind when I first dug into it, lies in what I like to call the professional's trap. It turns out their biggest strength, all those billions of dollars they manage, is also their greatest weakness. It's a handicap that they just can't escape. To really bring this home, let's invent a character. We'll call him Bob. Bob is a smart, experienced fund manager, and he is in charge of investing a mind-boggling $12 billion. I mean, that is an almost impossible amount of money to even think about. And for Bob, that's a gigantic problem. See, Bob's problem isn't that he's not smart, it's that he has too much money. He can't just go out and find one or two amazing little companies and put a bunch of money in them. If he tried, he'd end up owning the entire company. So instead, to get all that $12 billion invested, he's forced to spread it out over hundreds of the biggest, most well-known, most obvious stocks out there. Now, of course, we all know diversification is important, right? It's designed to protect you from what the finance people call non-market risk. Basically, that's just the risk of something terrible happening to one single company. You know, a factory burns down, a new product is a total flop. If all your cash is in that one stock, you are totally exposed. But here is the really fascinating part. You don't need hundreds of stocks to get the benefits of diversification. Just look at this chart. By owning just 4 different stocks in different businesses, you've already gotten rid of 72% of that company-specific risk. The biggest benefit happens right at the start. And by the time you get to owning 16 stocks, you can see you've eliminated 93% of that risk. The benefit you get from adding your 17th stock or your 50th or your 100th, it's almost nothing. So if that's true, why on earth is our friend Bob forced to own hundreds of them? And this gets us right to the heart of the professional's trap. Bob isn't buying his 80th favorite stock because he thinks it's a world beater. He's not buying it for diversification either. He's buying it because he has to. The sheer amount of money he's managing forces him to keep on buying, way past his best ideas. This is what you'd call diversification. It just waters down his best thinking and pretty much guarantees he gets average results. This slide just lays it all out so perfectly. You've got 2 completely different worlds. The professional, he's on a treadmill, always has to find new ideas, can only buy the biggest stocks, and he's judged every 3 months in a total fishbowl. But you get to be a gardener. You only need a few really great ideas to do well over a lifetime. You can look at companies of any size, and you have the single most powerful tool there is: patience. So if the secret to beating the pros isn't some fancy algorithm or a degree from an Ivy League school, then what is it? Well, your true secret weapon is actually much simpler than that. It's knowing where to look for the opportunities that everybody else is ignoring. To make this idea crystal clear, the source material uses this just brilliant analogy. So let's forget about the stock market for a minute and picture a couple of really savvy antique hunters. Their strategy for finding hidden treasures is the exact same one you can use. It's a really simple 2-step process. Okay, first, they don't go to the crowded, expensive galleries in the city. Nope. They take their expertise to places where there's way less competition. Think small-town auctions, estate sales. And second, they have one simple rule before they ever buy anything. Can I prove that similar things have sold for a lot more than this price? See, they're not trying to predict the future, they're finding obvious value right now. And that's it. That's the whole secret. Their advantage isn't that they're geniuses. It's that they are applying their knowledge where the competition is low. This is a perfect parallel for finding bargain stocks. You find them by looking in the corners of the market that are too small or too boring or too complicated for Bob and the rest of the Wall Street crowd to even bother with. You know, there's that old story about the plumber who gets called to fix a noisy boiler. He walks in, looks around, and fixes it with one single tap of his hammer. Then he hands the homeowner a bill for $100. The homeowner is furious, right? And the plumber just calmly says, the tap with the hammer, that was $5. Knowing where to tap, that was $95. It's the same in investing. The real value is knowing where to focus your effort. And that is really the big takeaway here. You have a built-in structural advantage over the so-called experts. Your path to success isn't about trying to outsmart them in the crowded arena of big, famous stocks. It's about playing a totally different game, a game they're not even allowed to play. You get to go treasure hunting in all the places they're forced to ignore. So the only real question left is, where are you going to start looking?
So, before you can even dream of finding those hidden gems, those companies that Wall Street has completely ignored, you've got to have your fundamentals down cold. Today, we're going to break down the absolute core principles of value investing. Think of it as the essential toolkit you just can't leave home without. Let me ask you something. Have you ever been totally, 100% convinced about an investment? You know, a sure thing that just couldn't miss, only to watch it blow up in your face in the most spectacular way possible?
I know I have. This happened to me when I was just 15 years old at the Hollywood Dog Track. I really thought I'd found the golden ticket. It was a greyhound named Lucky. And as you can see, the data looked perfect. In his last 6 races, Lucky had this super consistent time of 32 seconds. The other dogs in the race, their absolute best times were a whole 12 seconds slower. And at 99-to-1 odds, I mean, come on, it felt like a mathematical lock. So yeah, I bet every cent I had.
So what happened? You guessed it. Lucky came in dead last. Not even close. Turns out, I was missing one tiny but absolutely critical piece of information. All of Lucky's incredible times were from shorter races. This was his very first time running this longer distance, a little fact that apparently everyone else at the track already knew. My sure thing was a total mirage, and it taught me a huge lesson. Without a real foundation of knowledge, you're not investing, you're just gambling.
Okay, so that lesson from the dog track is really the starting point for everything we're diving into today. We're going to cover why you can't trust the so-called experts, then how to find your own unique advantage, how to rethink what risk really is, learn from the absolute legends, and finally, where the real profits are actually hiding.
All right, first up, trust no one. Period. Let's really dig into why most of the investment advice you come across is pretty much designed to failure.
I love this quote from the source material because it just nails it. The odds of somebody just handing you a fantastic investment idea for free are basically zero. That's just not how the system works.
And look, this isn't because analysts are bad people, it's because the whole system has these built-in flaws. They have this overwhelming pressure to issue buy ratings because, well, that's what makes them money, it generates commissions. If they put out a negative rating, they risk getting blacklisted by the company's management. Plus, there's this huge herd mentality. It is way safer to be wrong with everybody else than to stick your neck out and be wrong alone. On top of that, they're usually stuck in one industry, so they miss the big picture, and it's just not worth their time to research the small, weird, obscure situations where the real gems are often found.
And this slide, this is a brilliant little decoder ring for that analyst speak. You have to learn how to translate. When you hear an analyst say hold, what they often mean is sell this thing, but I can't actually say that or I'll lose my access. Or a phrase like source of funds, that could easily be code for yeah, sell, but we really want to do their next big investment banking deal. It's a whole language of euphemisms because sell is the one word you will almost never, ever hear. So, if you can't trust the experts, who's left? Well, you. And that brings us to this really cool idea, finding your net serves. It's all about figuring out your own game and then playing it relentlessly.
This idea comes from a great little story about a summer camp color war. In the biggest event, the Apache Relay, one of the challenges was to hit 3 net serves in ping pong. You know, where the ball just barely ticks the net and dribbles over. Well, there was this one camper, David Versatsky, who had this bizarre, almost supernatural talent for doing it on demand. And this one weirdly specific skill gave his team this massive, totally unfair advantage year after year.
Now, why on earth does a story about a summer camp matter? Because that advantage that David Versatsky had, that's exactly the kind of advantage you have as an individual investor. It reminds me of what Warren Buffett always says. There are no called strikes on Wall Street. You don't have to swing at everything that comes your way. You can just wait and wait for the perfect pitch.
And here it is, the key takeaway.
You don't have to play every single game. The stock market lets you be David Versatsky. You get to pick your spots. You can choose to only step up to the plate when you have a clear, undeniable edge, your own version of hitting those net serves. You only have to swing when the odds are just ridiculously stacked in your favor.
But wait a minute. Isn't that risky, putting all your eggs in just a few baskets? Well, have a look at this. It's not nearly as risky as you might think. What this chart shows is that the difference in potential ups and downs between a super diversified portfolio of 500 stocks and a really focused one with just 8 stocks is surprisingly small. Yeah, the potential downside is just a tiny bit larger, but the potential upside from your very best ideas, it's way, way bigger.
And this all leads us to one of the most important ideas of all. We need to completely rethink risk. The motto here is simple. Look down, not up. Worry about what you can lose, not just what you can gain.
First, let's talk about how Wall Street defines risk. They use this thing called beta, which is basically just a measure of how much a stock's price has bounced around in the past. So, in their world, a stock that has gone up a ton is actually considered riskier than a stock that's been stable. It's a completely backward-looking metric that tells you nothing about the actual business.
So, what should you be worried about? Real risk. And what is real risk? It's simple. The permanent loss of your money. That's it. It's not about whether the price wiggles up and down day to day. It's about how much of your hard-earned capital you could lose forever. At the end of the day, that is the only definition of risk that truly matters.
Okay, so how do you protect yourself from that real risk? Well, the answer comes from the godfather of value investing himself, Benjamin Graham. And it's his core concept, the margin of safety. All it is the gap, the cushion, between what a company is really truly worth and the price you're paying for it. If you think a business is worth $1 and you can buy it for 50 cents, that 50-cent difference is your margin of safety. It's your ultimate protection against bad luck, bad timing, or just being plain wrong.
Now, none of this is brand new stuff. In fact, these ideas are the bedrock of some of the most successful investing careers in history. It's all about standing on the shoulders of giants. So let's take a look at some lessons from the masters.
This table is a perfect summary. You start with Benjamin Graham, who was all about finding statistical bargains, buying stocks like you'd buy groceries, not perfume. Then you have his most famous student, Warren Buffett, who took that idea and evolved it. He said, you know what, it's actually much better to buy a wonderful company at a fair price, focusing on quality businesses with what he calls economic moats to protect them. And then you've got Peter Lynch, who came along and said, hey, just invest in what you know. Use your own knowledge from your job or from walking around the mall to find those huge winners before Wall Street does. Okay, so we've got the principles. We've learned from the masters. Now, the final piece of the puzzle. Where do we actually go to find these opportunities? And the answer is surprisingly simple. You look for change.
The best opportunities, the ones that Wall Street often ignores because they're too complicated or too messy, are usually found in the middle of major corporate events. We're talking about things like spinoffs, mergers, bankruptcies, restructurings, all these situations where big institutions are often forced sellers for reasons that have absolutely nothing to do with the underlying value of the business. These are the weird corners of the market where huge changes create incredible opportunities for anybody who's willing to do the work and look.
So to wrap this all up, I want to leave you with this one last thought. A lot of people look at investing like it's climbing Mount Everest, this impossible feat that's only for the super elite. But what if it's not like that at all? What if it's more like solving a crossword puzzle? Sure, it takes work, it takes some knowledge, and it definitely takes patience, but it's solvable. It's just about finding the clues and filling in the answers that everyone else has missed. The real question is, are you ready to pick up the pencil and start solving?
Welcome to The Explainer. Today we're diving into a really interesting and often overlooked corner of the market. It's a place where one company's trash literally becomes an investor's treasure. We are talking about corporate spinoffs, and we're going to break down the surprising reason why these cast-off companies so consistently beat the market and how you can learn to spot the real diamonds in the rough.
So let me start with a quick story. Picture this. You're at Latisse, which was once one of the best restaurants in the entire world. The famous chef, Andre Saltner, he comes over to your table and you ask him, hey, is this appetizer any good? He leans in and jokes, no, it stinks. Of course he's kidding. The whole point is, at a restaurant like that, everything on the menu is going to be world class. The most important choice you made was just deciding to eat there in the first place. And that really gets to our core idea today. In investing, where you decide to hunt for opportunities is often way more important than the individual stocks you pick.
And that brings us to our hunting ground for today. A place that, on the surface, looks like a pretty terrible restaurant. but it's one that consistently serves up some absolutely spectacular returns: the world of corporate spinoffs. So, what exactly is a spinoff? Well, to put it simply, it's when a big company takes one of its divisions and just sets it free. It becomes its own separate new company. Now, the absolutely crucial part of this whole process is that the shares in this new, usually smaller company are just given directly to the parent company's shareholders, often whether they want them or not. Okay, so why should we care? Well, the reason is simple: performance. There was this landmark study from Penn State that tracked spinoffs over 25 years, and they found something incredible. In their first 3 years of life, these new independent companies beat their industry rivals and the S&P 500 by an average of 10% per year. And this wasn't just a fluke. It's a consistent, long-term thing that just keeps happening. Now, let's put that 10% outperformance into perspective for a second. If we assume the stock market in general returns about 10% a year over the long haul, this suggests that an investor could potentially be looking at returns of around 20% a year. And that's just by holding a diversified basket of these spinoffs. No secret formula, no complex algorithm, just a portfolio of companies that Wall Street has basically tossed aside. I know what you're thinking. This sounds way too good to be true, right? I mean, these are the kinds of returns that could make the world's best investors jealous. So if everyone knows about this, why hasn't this opportunity just been competed away? Well, the fascinating answer is that the inefficiency, it's literally built right into the process itself. The opportunity exists because the process is just fundamentally broken. First, remember, the stock is given to shareholders who never actually asked for it. They bought the big parent company, not this new, smaller business. This leads to the second point: massive, indiscriminate selling. You have these huge institutional funds that might have rules saying they can't own small stocks, so they just sell immediately without even looking at the price. All that selling pressure creates bargains. And finally, you get this new management team that's suddenly free from corporate bureaucracy and is super motivated by stock options to make their new company a huge success. So how do we find the best of these opportunities? Well, the good news is you don't need a PhD in finance. You just need a simple playbook to help you separate the future winners from the companies that are, actually just junk. It really all boils down to a simple 3-step checklist. First, are the big institutions selling for reasons that have nothing to do with the business itself? Maybe it's too small or it just looks messy on a spreadsheet. Second, are the insiders, the managers who know the business inside and out, are they excited to own it? And third, is there a hidden opportunity that the market is just completely missing because of all that forced selling? Okay, let's see this playbook in action with a real-world example that, on the surface, looked like pure corporate toxic waste. This is the story of the Host Marriott spinoff. All right, so back in the early 90s, the Marriott Corporation had a big problem. They had this fantastic business managing hotels for a fee, but they were also drowning in debt because they owned too much actual real estate. So their solution was pretty radical. They split the company in two. Marriott International became the good company, holding that profitable, debt-free management business, and then Host Marriott became the bad company, getting stuck with all the unwanted real estate and pretty much all of the debt. As you can probably imagine, this was the reaction on Wall Street. Everyone just assumed Host Marriott was a guaranteed loser, a sinking ship that was basically designed to fail. But that overwhelming pessimism, well, it created the absolute perfect setup for any investor who was willing to look past the ugly headlines. And this is where our playbook just lines up perfectly. Host Marriott checked all 3 boxes. First, institutions didn't want it. It looked awful, it was small, and it was a real estate company, not the hotel manager they thought they owned. Second, the insiders absolutely wanted it. The guy who designed the split actually chose to become CEO of the bad company. That's a huge vote of confidence. Plus, the founding Marriott family kept their stake. And third, the hidden opportunity was leverage. Because of all that debt, even a small improvement in the hotel market would cause the stock price to absolutely skyrocket. And the result? Well, this so-called toxic waste that nobody wanted was quietly being bought up by investors who did their homework. And the stock? It nearly tripled in just 4 months. It was a spectacular return earned by looking for value where everybody else only saw risk. Okay, but here's a twist. The spinoff itself isn't always the main event. Sometimes the better, and often much safer investment is actually the parent company, which becomes a much cleaner, more attractive business once it sheds a messy division. A classic example of this is American Express back in 1994. For years, investors were just confused by Amex. Its fantastic, super stable charge card business was all tangled up with its really volatile investment bank, Lehman Brothers. By spinning off Lehman, Amex allowed the true value of its core business to finally shine through, clear as day. And the opportunity here was revealed with some really simple subtraction math. Before the spinoff, Amex was trading for about $29 a share. The new Lehman shares were valued at around $4, so if you do the math, you were effectively buying the new streamlined American Express for just $25. At that price, the company was trading for less than 10 times its earnings, which was an obvious bargain for such a high-quality brand. And if there was any doubt left that this was a huge opportunity, it was completely erased a few months later. That's when Warren Buffett revealed he had bought a massive stake in the company. He saw exactly what the spinoff had made so clear: a wonderful, focused business with an iconic brand trading at a cheap price. The spinoff had literally unmasked the value for everyone to see.
So let's bring all this together. What's the key takeaway here, and how can you actually apply this kind of thinking to your own investing?
You know, the most important thing to take away from this is that investing in spinoffs gives you an edge that has nothing to do with predicting the future. It's an edge that's based on understanding flawed market structures and predictable human behavior. The opportunity isn't in some crystal ball. It's in the built-in messiness of the process. By using a simple, logical checklist, looking for that forced selling by institutions, confident buying by insiders, and some kind of hidden angle, you can find these incredible opportunities that the rest of the market is just completely overlooking. And that brings us to the final and really the most important question. The same forces that created these massive opportunities for Marriott and American Express, they are still at play today. Every single year, companies spin off divisions that big institutions are forced to sell. So the question for you is, what corporate trash is Wall Street putting on the curb today that could be your next treasure? So today we're going to dive into the super high-stakes world of corporate takeovers. We're going to look at two completely different ways to play them. One is, well, it's a minefield of risk you probably want to steer clear of. But the other, that's an overlooked little corner of the market where, believe it or not, Wall Street's trash can literally become an investor's treasure. All right, let's get right into it. You know, our story really starts with a warning that's just as true in investing as it is in baseball. Some plays, they look brilliant from the sidelines, but when you actually try them yourself, you quickly find out just how many things can go disastrously wrong. And that brings us perfectly to our first strategy, a very tricky game called risk arbitrage. Okay, first things first, this is not some kind of shady insider trading. Risk arbitrage happens completely out in the open, after a deal has been publicly announced. An ARB, as they call it, is really just betting that an announced merger will actually happen, that it'll go all the way to the finish line. So how does that work in practice? Okay, so take a look at this. It really lays out the whole idea perfectly. Imagine Company A says, hey, we're buying Company B for $40 a share. The stock, which was just sitting at $25, shoots up to $38. That $2 gap between $38 and $40, that's called the spread, and that's the arbitrager's potential profit. $2 for every share they buy? Seems like easy money, right? Well, not so fast. That spread exists for a very good reason. See, that spread is basically you getting paid to take on two pretty major risks. First up, you've got deal risk. What if regulators step in and block the merger, or maybe the financing falls through? If the deal collapses, that stock you just bought at $38 could crash right back down to $25. Ouch. And then there's timing risk. You only get that profit when the deal finally closes, and that can take months, sometimes even longer, tying up all your cash. To see just how dangerous this can get, let me tell you a story. It's a real-world example from 1985 when a publisher announced it was going to buy the famous Florida Cypress Gardens theme park. And on the surface, I mean, this thing looked like the absolute perfect arbitrage play. And look at this chart. It shows you just how lopsided this bet really was. You could buy the stock for $7.50, hoping for a payout of $8.30. So you're looking at an 80-cent gain. But if the deal fell apart, that stock could easily drop back to $4.50. That's a $3 loss per share. You're risking almost 4 times what you could possibly gain. Not exactly great odds. But here's the crazy part. On paper, this deal looked like a total slam dunk, an absolute lock. The chairman of the park owned 44% of the stock, so getting shareholder approval was a sure thing. It was a stock-for-stock deal, so you didn't need to worry about financing, and there were zero, and I mean zero, antitrust or regulatory concerns. All the boxes were checked.
So what on earth could have possibly gone wrong? You literally cannot make this up. The main pavilion of the theme park, the heart of the whole operation, literally collapsed into the ground. A sinkhole. I mean, this was a risk that absolutely no one, not even the smartest analyst on Wall Street, would have on their checklist. All of a sudden, that sure thing looked very, very shaky. So what was the final tally? Well, a new restructured deal did eventually go through, but after 5 months of pure stress and nail-biting, the investment ended up as a loss. And this right here is the core problem with risk arbitrage. You're risking dollars to make pennies, and the one thing that ends up killing the deal is almost always something you could have never, ever seen coming.
So yeah, risk arbitrage, it's a crowded, super competitive game with tiny profits and a massive potential downside. But what if there was another way to play these deals? An approach that focuses on a totally overlooked part of the merger process where the whole dynamic is completely flipped on its head. And this is where we meet the hero of our story, something called merger securities. See, instead of offering all cash, a company buying another might throw in some other stuff, things like bonds or preferred stock, or these interesting things called warrants, which are basically long-term options to buy stock. They're often just a small sweetener to help get a deal across the finish line.
Okay, now here is the absolute key. You have to understand this. Almost nobody who gets these securities actually wants them. Think about it. The original shareholders bought stock in Company A. They didn't sign up to own some weird, complicated bond from Company B. Plus, big institutions like pension funds and mutual funds often have rules in their charters that literally forbid them from owning these oddball securities. So what does everybody do the moment these things land in their accounts? They sell. Immediately. Bam. They just dump them without even thinking about their actual value. And that massive wave of selling, where nobody's even looking at the price, well, that creates a golden opportunity for anyone who's willing to do a little bit of homework. It's an area where it's almost all sellers and very, very few buyers. Let's look at the buyout of a grocery chain called Super Right Foods to see just how powerful this can be. So here's what the deal looked like. For every share of Super Right, you got a big chunk of cash, over $25. But then tacked on were these two little afterthoughts. A small piece of preferred stock, and these warrants, which gave you the right to own a little piece of the new private company. I mean, compared to all that cash, this stuff was basically a rounding error. But see, while everyone was just looking at that headline cash number, the real treasure map was buried deep inside the merger documents, specifically the proxy statement. Now, this is the big, boring legal document that explains the whole deal, and it's where the company has to lay out its own projections for the future. And buried deep in there, what did it say? It said that the company's own management, the very people who were buying the company, believed that within 3 years, the new business would be generating $5 per share in free cash flow. This little nugget of information was the key to everything. Okay, so let's put this all together and look at the huge disconnect. On one hand, you have sellers who didn't want these weird things, so they just dumped them on the open market for about $6 a piece. But on the other hand, if you just did the reading, you knew that each warrant gave you the right to own a share that management itself believed could be worth $50 in just a few years. I mean, that is just a mind-blowing difference between price and value. So how did it all play out? Even better than projected. Just 2 years later, the company went public again, and those warrants that investors had happily sold for $6, they were now valued at over $40. Just an incredible home run, all from digging into the details that everybody else completely ignored. So let's just step back and look at the tale of these two strategies. You have risk arbitrage, a high-stress game of picking up pennies in front of a steamroller. And then you have merger securities, a game of finding treasure in Wall Street's discard pile. For individual investors, folks like us, the verdict is, well, it's pretty darn clear, isn't it? And this really leaves us with a final thought. The biggest opportunities aren't always in the big, splashy headlines. Sometimes they're buried on page 87 of a dense legal document, just waiting for someone who's curious enough to go look. So the next time you see a big takeover in the news, I'll ask you, are you going to focus on the headline, or are you going to be looking for the fine print? Welcome to The Explainer. Today, we're going dumpster diving. Yeah, you heard me. We are sifting through the wreckage of corporate failure to find hidden gems. We're talking about bankruptcy, and why that one word just might be the most misunderstood and maybe the most profitable in all of finance. I mean, let's be real, right? The word itself it sounds terrible. It makes you think of failure, total collapse, a black hole where investments just disappear.
It's definitely not a place you think to go hunting for your next big win. But what if that's exactly why the opportunity is so huge? What if this crazy, chaotic world of financial distress, the very place everyone is sprinting away from, is actually packed with mispriced treasures, just waiting for those who know how to read the map? So, how do we navigate this treacherous terrain? Well, this is our treasure map for today. First up, we're going to talk about the dragons that guard this territory. Then we'll learn how to spot the hidden X's on the map. After that, we'll look at some legendary treasures that have actually been dug up. And we'll wrap it all up with a set of golden rules to guide your own quest. All right, so before we even think about digging, we gotta understand the booby traps. Why do so many people get absolutely wiped out here? It's not random. Not at all. There's a very specific reason, and it all comes down to a simple pecking order. A list that decides who gets paid when the music stops. So take a look at this. It's basically the line for the lifeboats. When the ship goes down, the big banks with secured loans, they get on first. Then the bondholders get their turn. Then the company's suppliers, and yup, even the IRS gets a spot. And just look who's stuck at the very, very end of that line, the last to get anything, if there's anything left at all. That's right, the common stockholders, the regular folks who own the company before it went bust. And here's the harsh truth. In almost every single one of these cases, after everyone else on that totem pole gets their piece of the pie, there is absolutely nothing left. Zero, zilch. Those shares, even if they're still trading for pennies, are ultimately worthless. They get wiped out completely. And this right here, this is the #1 mistake people make. They see a company name they recognize, maybe an old blue chip stock, trading for like 10 cents a share, and they think, wow, how can I lose? What they don't get is that they're buying a lottery ticket that has already been declared a loser. The drawing's over. So here's the pivot. The really crucial point is this. The opportunity isn't in the dying embers of the old company, no. It's in the brand spanking new stock of the company that rises from those ashes. The end of a bankruptcy isn't just an ending. It's the birth of a brand new, and, you guessed it, often completely overlooked investment opportunity. Okay, so if the old stock is a total dead end, where do we find this new life? Well, this is where our treasure hunt really gets going. We're moving past the why it's so dangerous and into the how, as in how you actually sift through all that rubble to find the gold. And this gold, it actually has a name. This is the key term you need to know for today. Orphan equity. Think about it. This is the brand new stock that gets created during the bankruptcy process, and it's given to the old creditors. The company itself is clean. It's shed its old debt, wiped the slate clean, and it's ready for a fresh start. But this poor new stock, it's born into a very strange and very lonely world. And this is exactly why these stocks can be such incredible bargains. I mean, think about it. They're born with unwilling parents, the banks, the bondholders. They were forced to take this stock instead of cash. And they hate owning stock. They're debt people. So what do? They sell it, fast and cheap, just to get rid of it. And on top of that, there's literally no one to tell the news story. Wall Street isn't covering them, your broker gets zero commission for selling them, and management isn't out there doing some big promotional roadshow. They are truly orphans, unloved, and almost totally ignored. Okay, but not all orphans are created equal. You can't just buy any of them. You have to focus. You are hunting for quality businesses that just made a big but fixable mistake. So what does quality look like here? Well, think of a company with a great brand or a solid customer base, something with a real advantage that just got swamped by one specific problem. Usually it's just way too much debt. Or maybe it's a perfectly good company that had to use bankruptcy to cleanly settle some huge lawsuit. And you know the best part? The really small situations, they're often completely ignored, even by the pros, the so-called vulture investors. Now, all this sounds great in theory, right? But let's get our hands dirty. Let's dive into some real-world case studies to see exactly how this plays out. This is where the rubber really meets the road. First up, a company called Charter Medical Corporation. Now, back in 1992, they ran a chain of psychiatric hospitals, and they had just clawed their way out of bankruptcy. This was a textbook orphan, totally unloved and stuck in a really tough industry. So the market just saw a total mess. Here's a company still carrying debt, getting squeezed by insurance companies, and it has that ugly post-bankruptcy stigma all over it. But if you looked just a little bit closer, you saw this massive disconnect. It was a classic orphan, completely ignored by Wall Street. And because of that, it was trading for about $7 a share. At the same time, its competitors, who were no prize winners themselves, by the way, suggested a value closer to $15. That debt it still had, it was actually like a coiled spring. Any small improvement in the business was going to mean a huge return for the new stock. And what do you know? That is exactly what happened. The company got its act together, sold off a few hospitals, and just stabilized the business. Pretty soon, the market woke up and smelled the coffee. Wall Street analysts finally started writing reports, the story got out, and the stock tripled. It was a perfect example of patiently buying a good asset when literally no one else wanted to even look at it. Okay, next up, this one's a fantastic case. It's about a mind-numbingly dull business that was hiding a secret superstar in the basement, and the market was completely, totally oblivious. Let's talk about a company called Greenman Brothers. So on the surface, Greenman Brothers was just a middleman, a boring, barely profitable toy distributor. Total snooze fest. But buried inside this boring company was this exciting new chain of educational toy stores called Noodle-Cadoodle. Now here's the kicker. The stock was trading for less than the value of its warehouses and inventory, just the stuff it owned. That meant the market was valuing this exciting, fast-growing retail concept at less than zero. You were literally getting the chance to own a potential home run business for free. The value was right there, hiding in plain sight, but it needed a catalyst, right? A spark to light the fuse. Well, that spark came when management announced they were selling the old, boring distribution business to pour all their energy and cash into growing Noodle-Cadoodle. And boom. Suddenly, the whole story flipped. Greenman wasn't a stodgy distributor anymore. It was a high-growth retail dynamo. The stock shot up from under $6 to $14, basically overnight. It just proved the value was there all along, just waiting for someone to bother to look. Okay, these stories teach us something absolutely vital. It's not just about buying right. That's only half the battle, maybe less. You also have to master the much, much harder art of knowing when to sell. So here's the bottom line. You have to know what you own. Did you buy an average company at a great price, or did you buy a great company at a great price? It's a huge difference. Think about Charter Medical. It was a decent company in a tough industry. You bought it because it was dirt cheap. Once the price rocketed up and it wasn't cheap anymore, your edge was gone. That's a trade. You sell, you take your profits, you move on. But if you find a truly fantastic business that just temporarily becomes a bargain, think something like American Express in a crisis, well, that's an investment. You might hold on to that one for years. So trade the bargains, but invest in the greats. All right, let's bring it all home now. We're going to consolidate everything we've learned into a powerful playbook, a set of rules you can use to navigate this world of financial distress and spot opportunity where everyone else just sees fear. So here are the golden rules from today's explainer. Rule number 1, and this is the most important one, so burn this into your brain. Never, ever buy the old common stock of a company that's in bankruptcy. Your hunt is for the orphans, that new stock of companies emerging from the process. Then focus your search on quality businesses that were just tripped up by a fixable problem. After that, look for the catalyst, that one event that's going to force the rest of the world to see the value that you've already found. And finally, before you even think about buying, know your exit plan. You see? This completely reframes how you can look at the financial news. A bankruptcy announcement, it's no longer just a headline about failure. For the prepared investor, it's not an ending at all. It's a signal. It's a flashing light that a brand new and potentially very valuable beginning might be just around the corner. The map is now in your hands. Welcome to The Explainer. Today, we're going to pull back the curtain on a powerful concept straight out of the Wall Street playbook. You might hear it called other people's money. We're going to break down how a little bit of financial engineering, specifically a slick move called a recapitalization, can create serious value and juice returns almost like magic. So let's get right into it. You know, this quote really captures the spirit of what we're talking about. The core idea here is all about amplification. It's about taking a good investment idea and making it a great one. The world of finance is constantly searching for an edge, and we are about to explore one of the sharpest tools in the entire shed, leverage. When you use it the right way, man, it can be incredibly powerful. Okay, so let's start by exploring this strategy called a recapitalization, or a recap for short. Now, back in the 80s, these were all the rage. Companies used them to unlock hidden value or sometimes to defend themselves from a hostile takeover. You don't see them as much today, but, and this is important, understanding how they work is the absolute key to everything else we're going to talk about. So, what exactly is a recap? Well, think of it like this. A company basically decides to change its financial DNA. It swaps out a chunk of its equity for debt. So it goes to the bank, takes out a huge loan, and then uses that cash to buy back its own stock from the public. The result? The company has a lot more debt, sure, but the original shareholders still own the place. The big question, of course, is why on earth would they do that? All right, to really see how this thing works, let's get our hands dirty. We're going to break it all down with a simple, hypothetical company we'll just call XYZ Corporation. This is where the financial engineering really starts to look like magic, and we'll see how you can create value, seemingly out of thin air. Okay, check out this transformation. On the left, you've got your normal, everyday XYZ Corp. It earns $5 a share before taxes, pays its dues to the government, and the stock trades for $36. That's based on a pretty standard price-to-earnings ratio of 12. Simple enough, right? But now, look to the right. This is after the recap. The company took on a bunch of debt, and now it has to pay interest. That interest expense dramatically cuts down its taxable income, and that changes everything. So $36, that's our starting point, our baseline. Before any of this financial wizardry, the market says one share of XYZ is worth $36. Just lock that number in your head. Now, look at this. After the recap, that original shareholder is holding two things. They got $30 in cash or bonds from the company, plus they still have their share of stock. Now, this new, highly leveraged share is called a stub stock, and it's valued at $10. You add the 30 and the 10 together, and you get $40. That's $4 more than the original 36. The business is exactly the same, so where did that money come from? How is that even possible? I mean, if the company is selling the same widgets, making the same amount of sales, how can it suddenly be worth more? Well, this isn't smoke and mirrors. The secret, and this is the really beautiful part, is hiding in plain sight. It's the tax code. And here is the trick, right here. Before, $2 of every 5 in earnings went straight to taxes. Simple. But after the recap, the interest the company pays on its new debt is tax deductible. That is the whole ballgame. Because of that deduction, the government's take gets slashed to just 80 cents. And that extra $1.20, it doesn't just disappear, it gets rerouted directly into the pockets of investors. The company has completely legally diverted cash from the taxman to its own shareholders. Okay, so this new debt-heavy stub stock isn't just valuable because of that neat tax trick. It's now what you'd call a highly leveraged bet on the company's future. It's got such a tiny equity base that even a small improvement in the business can create an absolutely massive return for shareholders. Let's see what happens when XYZ Corp has just a pretty good year. And this, my friends, is where the leverage really kicks in. Look at this. For the original stock, a 20% bump in earnings gives you a 20% gain in the stock price. That makes sense, right? 1-to-1. But for the leveraged stub stock, that exact same 20% improvement in the business creates an incredible 80% gain for the shareholders. The debt acts like a giant lever, amplifying every little bit of good news. This is that explosive potential that gets Wall Street so excited. Now, unfortunately, as our source material points out, these big corporate recaps are pretty hard to find these days. But what if you, as a regular investor, could basically copy this powerful leverage for yourself? Well, it turns out you can, and you can do it with a tool that's available to almost anyone. The tool we're going to explore is called LEAPS. It stands for Long-Term Equity Anticipation Securities. I know, it's a mouthful, but the key idea is that LEAPS let you mimic the leverage effect of one of these corporate recaps. Think of it as a way to create your own personal stub stock on almost any big company you want, giving you that same incredible amplified power we just saw. Okay, so before we dive into LEAPS, we got to quickly cover the basic building block, a call option. Don't worry, it's way simpler than it sounds. A call option is just a contract. For a small fee, it gives you the right, but not the requirement, to buy a stock at a price you agree on today, that's the strike price, anytime before a certain date. Basically, you get to control all the upside of a stock for just a fraction of its actual cost. So a LEAP is just a call option with a really, really long life. Instead of expiring in a couple weeks or a few months, LEAPs can last for more than 2 years. And that is the secret sauce. That long runway gives your actual investment thesis, the real reason you think the business is going to do well, enough time to actually happen, and for the rest of the market to catch on. All right, enough with the theory. Let's see how this works in the real world with a fantastic high-stakes example. We're going to rewind the clock to the early 90s, to a gutsy bet on Wells Fargo Bank, right in the middle of a terrifying real estate meltdown. So picture this. It's December of '92. The California real estate market is in an absolute free fall. Wells Fargo is right at the center of the storm. and investors are panicking, dumping the stock. Fear is everywhere. But one analyst, a guy named Bruce Berkowitz, is looking past all that chaos, and he sees a once-in-a-lifetime opportunity. He thinks the bank is way, way stronger than anybody is giving it credit for.
And this chart, this shows you exactly why people were so terrified. For every single share of its stock, Wells Fargo had a jaw-dropping $249 of exposure to that collapsing real estate market. That was 5 times more than its biggest rival. I mean, on paper, it looked like a ticking time bomb just waiting to go off.
So this is the moment of truth. Here are the 2 choices Berkowitz had. He could buy the stock for $77 a share. If he's right and it doubles, great, he doubles his money. If he's wrong, he loses the whole $77. It's a classic 1-to-1 bet. Or he could use leaps. For just $14, he could control the exact same upside. If the stock doubled, his little $14 investment would explode into a $66 profit. And if the bank went under, well, he'd only lose the $14 he put in. You see that? That's called an asymmetric bet. You're risking $1 for the shot at making almost 5. That is a beautiful thing.
And the result? It was incredible. That potential $66 profit is pretty much what happened. Berkowitz's contrarian view was dead on. Wells Fargo weathered the storm, the stock soared, and for the people who used leaps, that tiny $14 investment turned into an absolute home run. All thanks to using leverage in a very smart, very controlled way. So let's tie all of this together. What's the big idea here? What's the common thread that connects a huge corporate recapitalization of XYZ Corp to a single investor buying options on Wells Fargo? Well, it all comes down to the intelligent use of leverage.
This quote just nails it. Both of these strategies, stub stocks and leaps, let you use leverage to magnify your potential gains. It's like borrowing money to get more firepower. But, and this is the most important part, there's a built-in safety net. Your absolute maximum loss is capped. You can never lose more than your initial investment, no matter how bad things get. So why does all this matter to you? Well, a few big reasons. First, it's about magnified returns. This is how you can turn your best ideas into truly great ones. Second, and this is huge, it's about defined risk. Unlike other ways of borrowing, you know your absolute worst-case scenario from day one. And finally, it gives you a whole new framework for thinking about risk and reward on any investment you ever look at. So we've seen how leverage, whether it's through a big corporate move or a personal leap strategy, can create these incredible explosive returns. We've seen how it can legally sidestep the tax man and create these beautiful bets where the upside just dwarfs the downside. But look, it's a double-edged sword. And that leaves us with the final and most crucial question that every single investor has to ask themselves. How do you decide when that potential reward is truly worth the risk? The real art isn't just in finding the lever, it's in knowing exactly when and how hard to pull it. Thanks for joining us on The Explainer.
Welcome to The Explainer. Today, we're jumping straight into what feels like a secret guide for most investors. It's all about spotting those special situations, the kind of opportunities that fly right under everybody else's radar.
So the author starts things off with this, well, intense analogy. Picture this. He's like a grizzled detective in a movie, you know, the one whose partner always seems to get into trouble. And he's looking right at you and asking, are you going to be that partner? It's a powerful way to say that, in this game, it's not just about making a quick buck. It's about survival. And guess what? The responsibility for that, it's all on you.
So think of what we're doing here as building your personal survival guide. We're going to arm you with the judgment, the tools, and frankly, the common sense you need to thrive in these special situations so you don't end up as that dead partner. Let's dive in and see how you can protect yourself.
Okay, first things first. Before you even think about hunting for opportunities, you got to have a plan to stay in the game. It all starts with what we'll call portfolio self-preservation. Let's break down how to build that foundation. Look, how you build your portfolio is your number one defense. We're not just talking about picking winners, we're talking about building a fortress. So having 5 or 6 different spinoffs, that makes a lot of sense. You're spreading out the risk. But 5 or 6 different leaps, you know, those super high-risk long-term options, that's probably a terrible idea. And it's the same thing with putting all your eggs in one industry basket or getting loaded up on margin debt. That's borrowed money, and it can force you to sell at the absolute worst moment. At the end of the day, your best asset is just plain old common sense. All right, so you've got the survival basics down. The big question now is, Where do you even begin? Because let me tell you, not all special situations are the same, especially when you're just starting out.
And you can see a really clear fork in the road here. On one side, you've got spinoffs. This is the recommended starting point, and for good reason. They're just easier to find, and as a group, they tend to beat the market. You see, the whole system is kind of set up to create these little bargains. Big institutions that own the parent company often just dump the smaller spinoff shares without thinking, which pushes the price down for you. You can literally, as the book says, bungle your way to some pretty nice profits. Then you have the other path, leaps and options. Whoa, this is the deep end of the pool. The warning here couldn't be clearer. It's like running through a dynamite factory with a burning match. Sure, you might make it out, but why on earth would you take that risk?
Okay, so let's say you've picked your path. You're going after spinoffs. Great, but how do you find them? Where do you even look? This next part is basically your field guide for the hunt.
You know, finding killer investment ideas isn't some kind of dark art or Wall Street secret. It's really just about having a system. And there are three main ways to do it. You can read a lot, you can check out specialized newsletters, or, and this is a great one, you can just copy the homework of the pros.
All right, path number one is simple, but it's not easy. You have to read voraciously, and your number one source should be the Wall Street Journal. Why? Because all the corporate stuff we're looking for, mergers, spin-offs, bankruptcies, it's all in there. And what's cool is, once you know what to look for, you start reading the news in a totally different way. That tiny little article about some spin-off, suddenly it's a giant flashing sign. The boring fine print, that's now the headline for you. You're basically training yourself to see what everyone else misses. Now, if you want something a bit more focused, newsletters can be an absolute goldmine. I mean, you've got things like the Outstanding Investor Digest that lets you peek inside the minds of top investors, or the Turnaround Letter that's all about companies trying to pull themselves out of a nosedive. But, and this is a big but, you have to remember the golden rule. These are just for generating ideas. They are not a substitute for you doing your own homework. Never.
Okay, path number 3 is probably the smartest shortcut out there. Just see what the masters are doing. Seriously, you can get the public reports from funds run by legends like Michael Price or Marty Whitman. And right there, you get a pre-vetted list of interesting companies they're buying. You can see what they own, sometimes even what they paid for it. It's an incredible way to get high-quality ideas dropped right in your lap for you to start researching.
So, you've got an idea. Maybe from the journal, maybe from a newsletter, maybe from a master investor. Awesome. But that's just the starting gun. Now you got to prove it's a good idea. This is where the real work starts. Time to do your homework. And your absolute best friend in this process? The company's own SEC filings. I'm talking about the raw, primary documents. This is where the company has to tell the truth. A Form 10? That's the complete playbook for a spinoff. A 13D? That's a big-time investor announcing they've bought a huge chunk of the company and what they plan to do. And the best part? It's all free, it's all online on the SEC's Edgar database. No excuses.
Now, after you've looked at the primary stuff, it's super helpful to check out some secondary sources. Think of these as your cheat sheets. Something like the Value Line Investment Survey, which you can usually find at the library, is amazing. It gives you a whole company's history and financials on a single page. These tools help you get up to speed fast and give you the context you need.
Look, let's be real. You can't be a serious investor if you don't speak the language. And the language of business is accounting. So we've got to tackle one of the most critical and honestly most misunderstood ideas out there, cash flow.
I mean, you hear it all the time, right? Cash flow this, cash flow that. But what does it actually mean? Why is it sometimes way more important than the net income number everyone else obsesses over? And how do you figure it out for yourself?
Okay, here's the absolute key. Think of net income as what a company says it made on paper. But free cash flow, that's the actual, cold, hard cash that ended up in its wallet at the end of the year. Net income can be fudged around with accounting tricks like depreciation, but free cash flow, that's the real deal. It's the money they can use to pay you dividends, buy back stock, or grow the business.
And the good news is, calculating it isn't some crazy math problem. It's pretty simple, actually. You just grab the company's statement of cash flows. You start with their net income, you add back the stuff that wasn't actual cash expenses, like depreciation, and then you subtract the real money they spent on big-ticket items, like new factories and equipment.
Let's just use the example from the book so this really clicks. Imagine the company reports $20 in net income. Okay, we start there. Now, we add back the $6 for depreciation and $3 for amortization. Remember, those are just numbers on a page, not real cash that went out the door. Then, we subtract the $5 they actually spent on new equipment. And voila! You get a free cash flow of $24. Now think about that. The company said it made $20, but it actually generated $24 in cash. That's 20% more. This is exactly how you find those hidden gems, companies that are way healthier and more profitable than they look on the surface.
So, everything we've talked about today, this isn't the finish line, not even close. This is the starting block. The truly great investors, the ones who win year after year, they never stop learning. They are always getting better.
And if you want to keep that education going, here's what the author calls his investor's bookshelf. These are the classics, the must-reads. You've got everything from the Bible of value investing, The Intelligent Investor, to Peter Lynch's awesome One-Up on Wall Street. Seriously, investing in your own knowledge is the highest return you'll ever get.
And as you head out on your own, just keep this one thing in mind. It's a really important principle. Your goal isn't to fill a notebook with 100 half-baked ideas. No, it's to find just a few, maybe 5 or 6, truly great ideas that you know inside and out. That's where the real money is made. It's about depth, not breadth.
So there you have it. We've gone through the survival guide, we've talked about where to begin, how to hunt for ideas, what tools to use, and even how to start valuing a company. You've basically been handed the map and the compass. The rest of the journey, well, that's up to you.
You know, we're so often told to just focus on the finish line, right? That one magic number that means, okay, I've made it. But what if that's the completely wrong way to think about investing? Today, we're going to dig into a totally different philosophy, one that says all the fun is actually in getting there. And I think it might just change how you see your own financial future.
This quote, man, it just gets right to the heart of it, doesn't it? We're trained to see investing as this big race to a destination. But this idea completely flips that on its head. It suggests the real value, the real fun, is in the process itself. Because honestly, think about it. Once you hit that number you've been dreaming of, what happens next? The journey, it never really ends.
So here's how we're going to break this all down. First, we'll talk about the investor's voyage. Then we'll uncover what the real prize is and hint, it's time. After that, we'll look at your essential navigator's tools, learn how to weather any kind of market, and we'll wrap it all up with this really cool metaphor of your snowball on a hill.
Okay, so let's start our journey with a really simple analogy. Sailing. Just imagine you're out on the water, not racing to get somewhere, but just enjoying the feeling of being out there, managing the sails, responding to the wind. This whole mindset, it's a perfect metaphor for a much healthier way to approach investing.
I mean, think about someone like Warren Buffett. The guy passed the point of needing more money decades ago. So why does he keep doing it? It's because for him and for so many other successful investors, it's about the thrill of the game, the puzzle, the challenge of navigating these complex market waters. And that mindset is so crucial, because if you can't find some enjoyment in the process, you're just signing up for a really stressful trip.
And this really brings us to a huge contrast between two types of investors. On one side, you've got the destination investor. This person is totally fixated on the outcome. They lose sleep when the market dips, they panic and sell at the worst possible time. But then you have the journey investor. This person actually embraces the process. They see a downturn as a challenge to solve, they stay patient, they stay methodical. And guess what? That's what leads to long-term success.
Okay, so if the journey itself is the point, what are we really trying to achieve here? It can't just be about piling up cash. No, the true prize is something way more valuable than that. And of course, let's be real, money has some very important, very real benefits. It can give you a fundamental sense of security. It can mean a comfortable retirement. It gives you the power to really provide for your family. And it can even be a huge force for good in the world, letting you help others in a big way. These are the immediate, tangible goals of our financial journey for sure.
We all know this one, right? It's practically drilled into our heads from the time we're kids. We trade our time for money at our jobs. We think about our hours in terms of dollars and cents. It's kind of the default operating system for a lot of the world. But what if we've had it completely backwards this whole time? The real, incredible power of money isn't that it's like time, it's that it can buy you time. And time is the one currency you can never, ever get more of. Once an hour is spent, it is gone forever. Wealth, when you use it wisely, is the ultimate tool for reclaiming your own time. And ultimately, that's the real end goal of this whole investor's journey: freedom. It's the freedom to spend your limited, precious time on the things that actually matter to you, your family, your community, your passions. Wealth is just the key that unlocks that door. All right, so now that we've kind of figured out our why, this whole pursuit of time and freedom, let's get practical. Let's talk about the how. What tools do you actually need in your toolkit to navigate this journey? You might be surprised at how simple they are.
This is the big one, isn't it? The question that holds so many people back. There's this myth that to succeed in the stock market, you have to be some kind of Wall Street genius who has all this secret knowledge. But is that actually true?
The answer is a huge, resounding no. Here's what you really need. First, just a basic ability to read a financial statement. Second, plain old common sense. Third, you need the patience to let your experience build up over time. And fourth, and this is the big one, just a simple willingness to do a little extra homework. That's it. That's the secret sauce. No genius required.
I mean, this is such an empowering idea, isn't it? The barrier to being a successful investor isn't some crazy high IQ or a secret handshake. It's effort. It's that most people just aren't willing to put in that little bit of extra work. And when you really think about it, that's actually pretty fair. Success is right there for anyone who's willing to earn it.
Okay, so once you're armed with the right tools and the right mindset, you're ready for the next big step, building a strategy that doesn't need a constantly rising market to work. You need one that works in any weather, whether the wind is at your back or blowing right in your face.
First, we have to start with a fundamental belief. The stock market, over the long haul, is fair. It's not a casino. It's a reflection of the real-world growth and innovation of the businesses that make up our economy. Now, that doesn't mean it goes up every single year. Nope. There can be long, frustrating stretches where it feels like it's going nowhere, but eventually it catches up to reality.
So how do you win even when the market is just flat? Well, one strategy is something called special situation investing. This isn't about betting on the whole market to go up. It's about finding these unique opportunities created by specific corporate events. You know, things like mergers, spinoffs, or big reorganizations. These situations kind of create their own momentum, totally separate from what the S&P 500 is doing.
And this approach is so powerful because these corporate events are always happening. New bargains are constantly popping up, no matter if the market is soaring or sinking. Your success depends on finding real inherent value, not on trying to guess what everyone else is feeling. It means that if you just do your homework and stay disciplined, your hard work will pay off.
And that brings us to our final, and I think most powerful idea. We've talked about the mindset, the goal, the tools, and the strategy. Now, let's put it all together and look at the incredible potential waiting for the journey-focused investor. So here's this final awesome metaphor. I want you to picture everything we've just talked about, the mindset, the tools, the strategies, as this one small snowball. And it's just sitting there, right at the top of a very long, very snowy hill. It's just pure potential energy waiting for a push.
You now have the map. You have the gear you need to get up to that snowball. The knowledge is yours. But here's the thing. It's not going to start rolling by itself. Your job, your only job, is to give it that first little nudge. And as it starts to roll, it's going to pick up more snow, getting bigger and faster and bigger and faster, all thanks to the incredible power of compounding.
And that's where we're going to leave it today. Because this isn't just theory, right? It's a practical toolkit, and it's a call to action. The map and the gear for your own financial freedom are right here, in your hands. So the only question left to ask is, will you start the climb?